Good morning, everyone, and thank you for joining us for Nedgroup Investments Insights at 10. My name is Robin Johnson, and I am Head of Investments at Nedgroup Investments. Today, I'm joined by Ian Anderson, Portfolio Manager of the Nedgroup Investments Property Fund and CIO of Bridge Fund Managers. Now, the market pullback has been particularly severe on listed real estate securities, as we've heard many times in the first 6 months of this year, not just in South Africa, but around the world, despite the contractual rental income that should support such valuations. Over the last 3 months, we've seen a bit of a rebound in equity markets. Here in South Africa, we've been led out by the resources sector with an incredible 40% bounce. But the listed property businesses have also kept pace with the broad market, delivering 20% total return. Real estate is a sector which I think has a unique, very tangible asset attached to the production of cash flow. Now, if you just think about any of the buildings in which you may pay rent or your businesses may pay rent, how likely is it that you're going to get a 30 to 50% haircut on the amount you pay every month? However, through the last quarter, we've received frequent updates from companies in the sector on their intentions with regard to payout ratios and expected dividends, which has intensified uncertainty amongst the investors and left them wondering what the future of real estate looks like post-COVID. At this point, I'm going to hand over to our expert in all things related to the local real estate market and let Ian Anderson provide more insight. As we go through, please feel free to submit questions. I will pick them up on the Q&A component and I'll pose them to Ian after he's finished his short presentation. So on that note, thanks very much, Ian, for joining us, and I'll hand over to you now.
Thanks very much, Rob, and good morning, everybody, and thank you for joining us. As Rob said, it's been a fairly interesting 6 months. Obviously, for real estate, it's probably been a fairly interesting 2 years, but the last 6 months have been particularly volatile, and that's really what I want to chat about today. We just start with a quick update in terms of the performance for the second quarter, just to set the scene. As Rob has already mentioned, we have seen a recovery in prices, albeit we're still a long way off where the peaks were. The Nedgroup Investments Property Fund was up just over 19% over the last 3 months, outperforming the ASISA category average, but falling just a little bit shy of what the overall property sector did. And I think the more important number is what the fund has done year to date. Yes, we're down 31%, but that's a substantially better outcome than what both the ASISA category average has delivered and also what the market has delivered. And I think a big part of that is because of the different positioning of the fund. And later on in the presentation, I'm going to spend quite a bit of time, particularly looking at the different retail exposure that the fund has, because I think retail has been one of the sectors or one of the groupings within property that has been the most negatively impacted. It's certainly the one that has received the most news, as retailers haven't been able to operate during various phases of lockdown. And even now that we're out of those lockdowns, it's still very difficult for them to generate the revenues that they did pre-COVID-19. If we just have a quick look at some of the positive contributors, again, it's made up of businesses that we own, that a lot of other listed property managers don't own. Tower, Accelerate, Fairvest, Spear, and Grit are all very unique, very specialist REITs, and obviously businesses that we've liked for a long time, and as a result they did make a very positive contribution. Just in terms of that Fairvest position, the average weight is 13%, which is obviously a little bit high relative to where we want it to be. The share price has rallied another 7% so far this week, and we've taken the opportunity to lighten that position. And in fact, we managed to sell about 11.5 million shares the other day. There's strong appetite for the business, and I'll describe why that is later on. In terms of the negative performance attribution, in fact, there were only 3 companies that generated negative returns in the portfolio. So Equitas and Vukile, although they're on that list, actually generated positive returns, but the contribution was amongst the lowest in terms of the portfolio. But you can see very strong returns from Tower and Accelerate and Fairvest, generating between them, close on 12, just over or just under 12% of that overall 19% return. We just look at some of the returns that were generated in the second quarter, and what I'm focusing on here is specifically the South African REITs. So some of the offshore companies that you can invest in via the JSE are not represented here. These are businesses that form part of the SA REIT Association, and you can see that in two instances, in the case of Accelerate and Rebosis, the returns were in excess of 100% over the quarter. I mean, there were a couple that lagged, Octodec, and clearly hospitality, which owns hotels, is going to come under tremendous pressure. Octodec was a bit more difficult to describe because of the nature of their investments. They should actually be doing a lot better, but we think that there was a large seller in that market. They now offer, I think, incredible value. But by and large, most of the companies generated returns of around 20 and 30%, and hence the strong return for the market overall. Just in terms of the current fund positioning, as I mentioned at the beginning, the fund, we believe, is well positioned, particularly given the headwinds that face certain property types like office and retail. We have very high exposure to mass market retail in rural areas and townships, as opposed to large shopping centres in urban areas. And it's really those large shopping centres in urban areas where a lot of the pain is being felt right now. Most of those mass market retailers were able to open early on during lockdown, and so the landlords of those shopping centres were able to collect the bulk of their rent from much earlier on. I mean, today you still only have rent collection rates in some of these larger centres of between 50 and 60%, whereas in the mass market retail, the collection rates are in excess of 90%. So cash flows have returned much more quickly to shopping centres in rural areas and townships. And then also importantly, we've got very low exposure to offshore, and particularly offshore that was funded through the use of cross-currency interest rate swaps, which is a derivative instrument and is very much dependent in terms of its margining requirement on what happens to the rand. So when the rand blows out, these companies are forced to put a lot more money in order to meet those margin requirements. And so it has a major impact on treasury management operations inside of these companies. And to the extent that Resilient, for example, has announced that they've exited all of their cross-currency interest rate swaps because it just adds far too much volatility. Now that comes at a price, because obviously using those cross-currency interest rate swaps has allowed companies to substantially reduce their cost of capital, because you swap out your South African debt for European debt and you replace an 8 or 9% cost of debt capital with a 2 or 3% cost of debt capital. So by reversing that process now, we will see distributions come under pressure. We have been able to increase our cash position in the portfolio. We think it's good to keep powder dry and to take advantage of some of the extreme volatility that we see in the market. We know where that money is going. We have target prices in mind for a couple of stocks that we believe are either significantly undervalued at the moment, or that are more immune to the headwinds that are facing the real estate sector. So looking to increase our exposure to warehousing is one of the things that we are focusing on. We have a large position in Grit, and that's mainly as a result of the recently announced corporate action. The share price rallied substantially. They are cancelling their listing here in South Africa. They are listed on 3 exchanges at the moment: the London Stock Exchange, the Stock Exchange of Mauritius, and the JSE. They've decided to reduce that to just 2, Mauritius and London, and so they have arranged for that listing to move, and as part of that process, a certain number of shares are going to be acquired at a price of 14.90 rand. At the time of that announcement, the share price was around 12.20 rand. So the Grit position has become large on the basis of this corporate action. In fact, I see the share price today is over 15 rand. I'm not quite sure how that's happened, but given that there's a 14.90 rand offer. But I think importantly, the value of the business on the LSE, or the price on the LSE, is substantially higher than the price on the JSE, and people are now realizing that this value is going to be unlocked. And then I think from a distribution perspective, as expected, the second quarter distribution was substantially lower than the corresponding period of a year ago. And that was mainly as a result of companies choosing to defer the payment of their interim dividends. And I'll chat a little bit more about exactly how that's playing out and why that played out in a couple of slides' time. Just in terms of that difference in retail exposure that I alluded to in a previous slide, if you look at the Nedgroup Investments Property Fund, and what we've done here is we've looked at the retail component in the fund based on 3 different categories. Shopping centres, where the GLA, which is gross lettable area, is over 50,000 square meters. Then we've looked at it 25 to 50,000 square meters, and then less than 25,000 square meters. So obviously your greater than 50,000 square meters are your regional and super regional malls, and those are typically in more urban areas. 25 to 50,000 square meters sort of straddles both community and neighborhood and regional. And then obviously less than 25,000 square meters are typically your neighborhood and convenience centers. And you can see the Nedgroup Investments Property Fund has a substantially larger allocation to those smaller centers. And as I mentioned earlier, many of those centers return to almost full cash flow generation during this lockdown period, where the 50,000 plus square meter centers are still battling to collect even 60 and 70% of their rent. The STAPI index, which is the SA listed property index, obviously has a very different looking picture. You know, again, there it's dominated by much larger shopping centers. And I think that's probably why some of the concern that has been raised by market participants about the future for real estate in South Africa are valid, because of the types of the sort of exposure that you would get by just owning the index. Many of the CEOs and commentators have indicated just how better it is right now to be owning these smaller convenience and neighborhood centers than it is to own the large regional and super regional centers. There have been a couple of presentations recently where that's one of the key points that has been raised. Just in terms of the outlook, and this is my final slide before we move into the Q&A session, I think it's still far too early to gauge the full extent of the pandemic on long-term property fundamentals. We obviously know that today the hospitality industry is under tremendous pressure, retailing, particularly those centers anchored by your large fashion and apparel retailers, and the office market are under pressure. But at the same time, we've seen other sectors like warehousing and self-storage remaining resilient. And just on that, we today get our dividend from storage, which is another big holding in the fund. It's about 8% of the portfolio. They paid a full dividend and grew that dividend by 5%. So although you've got all of this negative news about dividends being cut and dividends not being paid, there are still businesses out there that are capable of growing their distributions and paying their dividends. And so that dividend is now in the fund as from today. What we do know is that rent collection rates have on average been improving. On average, they've moved back above 80% in June, having gone as low as 60 to 70% in April. Again, there were different rates depending on the different property types. If you were an owner of a large shopping center, you probably only collected 35 or 45% of your rent in April. If you owned a warehouse or a self-storage unit, you were getting 95 to 100% rental. Just in terms of the property industry group, which has obviously been working behind the scenes to try and relax the REIT legislation or the requirements from the JSE for the 75% minimum payout ratio, as well as looking to get tax relief from National Treasury. Those discussions are ongoing, but it's unlikely that they will get either. Just some of the companies that we've chatted to recently, and particularly our discussions with Vukile have got a management team that are very much involved in this process. Lawrence Rapp and Lawrence Cohen, the CEO and CFO, are very much involved in these discussions, and they both agree that it's unlikely that the JSE will be able to change the REIT requirements, and certainly National Treasury is not interested in giving any tax relief at this stage, given the huge shortfall that they already are experiencing. What the JSE has done, however, though, is allowed REITs to delay the payment of their dividend by a further 2 months. So right now, REITs have to pay their dividends within 4 months of the last reporting period. Now that has been extended to 6 months. but importantly, they still have to now pay out 75% of their dividends. So what we do think is that there will be dividends paid, and most companies are now going to be forced to pay those dividends. They had withheld the dividends in the hope that they might get this dispensation. The dispensation is unlikely to come, and so dividends will be paid in the third and fourth quarters, but those ratios will be a lot lower. Both SA Corporate and Vukile have already announced that they're moving to 75% payout ratios, and that clearly is going to have an impact on distributions. Trying to forecast short-term distributions is difficult, but we do expect to still receive between 60 and 70% of our beginning of year forecasts. So that's a range of between 7.5%, 8.5%. In fact, our current forecasts are above that number, but we're just building in a level of conservatism into our estimates. And that 7.5% to 8.5% will still translate into a yield on current prices of between 14 and 16%. We do think that distributable earnings, and this is not distributions per se, or dividends, this is the earnings from these companies, will return to more normalized levels in 2021, but we have to assume that those lower payout ratios are going to persist for some time for these companies to restore balance sheets. They obviously don't know what's going to happen to valuations, and so they need to make sure that their loan to value covenants aren't breached. The only way that you do that is by retaining more cash. It's going to be difficult for them to raise equity. It's going to be difficult for them to raise debt. So the only way that they can continue to raise capital, which they will then use for operating expenditures as well as capital expenditures, is by retaining a portion of the dividend. But we do expect the distribution to grow to around 9.5% to 10.5% in 2021, which is a dividend yield of between 17 and 19%. So from an outlook perspective, certainly when you compare that to the yields on cash and the yields that you get from money market instruments or bonds, the property sector is obviously still offering substantially higher yields. There is obviously a lot of uncertainty, but the fact that we've now moved to much less restrictive lockdown conditions is positive. The news yesterday from the High Court or the Western Cape courts around the payment by insurers for business interruption, that's obviously going to also be positive if it happens. Obviously, the insurers are going to fight that. But I do think that the sector looking forward offers very attractive initial yields. Obviously, there's going to be some volatility, but I think the sort of trend that we saw in the second quarter, and which we've seen continue into the third quarter, is likely to continue for the remainder of the year. Prices rise as more and more good news comes into the equation. And with that, I'll hand it back to Rob. Thank you very much.
Thanks very much, Ian. That was a comprehensive update. I really appreciate that. We've had some fantastic questions come through, so I'm going to dive straight in. First one is, you touched on this about the property group looking to get concessions from the JSE or the government on how much they have to pay out to retain their REIT status. So you said you don't think that'll happen. What if they don't make that 75% payout ratio? What happens to them?
So I think there are two things. So the first is that the way that it's working at the moment is the JSE is saying, okay, your first test has to be that you pass the solvency or your solvency and liquidity tests. So those REITs that are paying less than 75%, but it's because they're failing their solvency and liquidity tests, they will continue to retain their REIT status. And there are a couple of businesses that are able to do that. Unfortunately, if you're passing your solvency and liquidity tests after the payment of your dividend and you don't distribute 75%, you will lose your REIT status. You will then be taxed on everything, including any dividends that you paid, and you will only be able to get your REIT status after 2 years. So it means that these companies are going to be forced to pay their dividends, and at least 75% of their earnings as dividends in the third and fourth quarters of this year.
Okay, thank you. And if companies have put a stop to the dividends that they're paying or their interim payments, does that mean you expect a significantly larger payout in the back end of the year, depending on when the year end for each of the companies is, obviously?
Yeah, I mean, absolutely. That's part and parcel of our assumptions at the moment, is that those interim dividends that were postponed in the second quarter, and some will probably still be postponed in the third quarter, will be paid in the fourth quarter of this year and the first quarter of next year. So if you look at our current forecast for the fourth quarter, they are substantially higher than what was paid in the fourth quarter of a year ago. And that's simply because we're not just getting final dividends from companies, we're getting the postponed interim dividend and the final dividend, albeit that the combined value of the interim and final dividend will only be 75% of their distributable earnings. So we've built that in. We've said, okay, companies will one, have lower distributable earnings, and two, they will also only pay out 75% of those dividends. But importantly, it's an interim dividend and a final dividend in the fourth quarter. And there are about 4 or 5 companies in our portfolio where we know they will definitely pass the solvency and liquidity tests, and therefore they will be forced to pay the interim dividends that they've delayed.
Do you think we'll ever get back to the situation where businesses are paying out more than 100%, or even 100% seems irresponsible now?
No, I think those days are long gone. I mean, just chatting to the management teams, I think that and it was interesting, Vukile, which was one of the most recent discussions we've had, and they were one of the first companies to say that, you know, they're going forward at 75%. They're not going to budge from that. Maybe in 2 or 3 times, if 2 or 3 years time, if the market stabilizes a bit, they might consider it. But for the time being, when you have very little equity investor appetite, so your generalist and fixed income managers, the non-traditional property managers are not investing in the sector. It's very difficult to raise equity capital. And so the only source of capital that you have, and bearing in mind these businesses require capital all the time to maintain and improve the overall quality of their portfolio, so that necessitates in the past them raising equity or raising debt. You can't do that now. So the only way you can raise that capital is by retaining dividends. So we think that the sort of lower payout ratios will be more permanent. And you can see that in our 2021 and 2022 forecasts, where we don't get back to the 12, 13 and 14 cents distributions that we paid previously, but we start moving to around 10 and 11 cents. But that's still close to a 20% yield. Still very, very attractive in the current market.
But then if you think about it, or if you roll that forward, if they're retaining more of their earnings, and that should shore up their balance sheets, that making them more attractive businesses. Can you comment on that? But also then, can you comment on what the debt levels within the SA REIT market look like at the moment?
Yes, I mean, I think I'll answer the second question first, because it's a bit more difficult to answer, and it's more speculative on my part. Yeah, we don't really know what those loan to value ratios are, because we haven't seen the next round of valuations. We think the next round of property valuations is likely to see at least 10% of the value shaved off. You know, we've seen some of the notes being put out by valuers looking to adjust their assumptions around base rentals, around rental growth, as well as around the cap rates or the discount rate. So, you know, at the moment, the average loan to value is just below 40%, but it's likely to increase to above 40%, which means to the first part of your question, the companies are going to be forced to retain more capital in order to get those LTVs down back below the 40% mark. Now, each company has a different target, because it depends on your relationship with your banks. Some banks have imposed, you know, debt covenants of 45% of loan to value. Others are at 50%. Some are at 55%. So depending on how close you are to breaching your covenant, and when you breach the covenant, the banks basically can take control of your cash flows. If you're close to breaching those covenants, well, then you're going to try and retain as much as you want. If you're a long way off that mark, well, then you can probably have a payout ratio of 80 or 90%. You don't need to go down to 75%. But a business like Vukile, where the LTVs are already quite high, they're being forced to go down to the 75%. And I would say that for at least the next year or two, most of the listed property companies will rather be at 75% than say at 90% payout ratio.
And lower interest rates, has that had a positive impact on their ability to pay down debt or service their debt?
Yeah, I mean, there are usually two major covenants that the banks are interested in. One is the actual loans relative to the value of the portfolio, but importantly, it's also the ability to service those loans, and that's usually done on a sort of interest rate coverage ratio. So how much of your profits cover the interest that you have to pay? And for most of the banks, that sits at around 1.5 times, maybe in some cases it's a lot higher. The important thing is, with interest rates having fallen so dramatically, that is a metric that has improved across the board. Now, the way that REITs fund themselves in the debt markets, it doesn't happen immediately. They don't just have overnight facilities. Most of these loans are fixed for periods of 2, 3, 4, and 5 years, and so the interest rate adjustments will only happen when those fixes mature. There are companies that have much higher proportions of floating rate debt, and so you should see that impact happen almost immediately. It's been indicated by 1 or 2 of the smaller companies that we own that don't have as much fixes in place, that they will have an immediate benefit, and you should see it come through in the next 6 months. I mean, for some businesses, it releases as much as 200 million rand of cash flows. That's how substantial these interest rate cuts have been. So I think overall the sector is in much better shape because of these lower interest rates. I also think the lower interest rates persist for a lot longer, just like they are going to globally. We don't see another rate movement at all for the next 12 months at least, and it's probably only going to be the 3rd or 4th quarter next year where the South African Reserve Bank might look to normalize interest rates again. In other words, maybe raise by 25 or 50 basis points. So that should be very positive for REITs in South Africa.
Thanks, Ian. We had quite a few questions on A shares versus B shares. Would you just describe what that means? And also, do you have a view on A versus B? Is it very company specific?
Yeah, so I mean, obviously, without getting into too much detail, it's a structure that was designed to appeal to 2 different sets of investors. The A shares are like preference shares, so they get a preferential right to the income. The income is determined by a formula. The formula, you start with a base level of income, and then it grows at the lesser of inflation, or 5% every year. That's the sort of the general structure, and then any income that is left over goes to the B unit holders. So the A unit holders are your traditional income or bond-like investors, whereas your B unit holders are your typical property investors. And that's how we approached it. We have owned A's in the past, but by and large we own the B's. And obviously, when things are going well, the B's do well. But clearly, when things don't go that well, the B's suffer, because the A's are getting income that was previously paid to the B's. And so the B income drops substantially while the A income can continue to grow. But from where we sit today, and given the sort of base effects that have been created in a lot of these businesses, we should start to see a strong recovery in the B's. And so we continue to remain committed as property investors to the B's, and we don't have any A exposure in the portfolio. But it works differently for different companies. Some companies have a lot more A's than B's. That's the case of Fortress, and so that's really problematic for them. A business like Dipula has an equal number of A and B's, and they actually have to be issued together. So there's a lot less of an issue in the Dipula. And then Arrowhead, for example, has very little A's, and in fact has almost no A's relative to the B's. So that structure, it's more of a legacy structure that hopefully they can address in the future. The other big problem that you have with certain A and B structures is that the A's also have a different formula for determining what value they are given in the case of a breakup or a sale of the business. It's not linked to the underlying value of the property portfolio. It's linked to the value that the shares traded at on the JSE. So those A's, there's a mismatch there as well in terms of the net asset value. And that has caused a significant amount of problems, particularly for Fortress, where if you push the A shares higher and higher, eventually the B shares become worthless. And that's what we saw happening. And that's why you've seen that massive value destruction in the Fortress Bs. We don't own Fortress in the portfolio, and until such time as they can address that capital structure, we're not going to own any Fortress shares.
Thank you very much. you touched earlier on rent collections improving, and you touched on the different types of businesses that have varying levels of from retail through to warehousing. What about government tenants? And then on the back of that, you hold Delta and Rebosis in the portfolio. What have their rent collections been like?
Yes, I mean, surprisingly, through this whole process, government has been the best tenant to have. So government have paid all of their rents on time. They haven't looked for any concessions. They haven't engaged with their landlords looking for any relief whatsoever. And it's not, I mean, obviously it's not just through Delta and Rebosis that we have exposure. Depula and Octodec and even one or two other private investors who we've engaged with on government leases have said exactly the same thing. So you've got this very stable cash flow, and I think it's also important to understand that in terms of the office exposure in the portfolio, we have a much bigger sovereign underpin, and therefore we anticipate much better rent collections. In fact, if you look at what Delta and Rebosis were collecting, whereas most other companies were at sort of 55, 60 and 65%, Delta and Rebosis were above 80 and 90% rent collection in their office portfolio. So I mean, government, surprisingly, maybe not surprisingly, because they've obviously got to lead the way in this pandemic, are being very good in terms of the payment of their rental. We think that continues.
Okay, thank you. And just moving on to retail, not a great picture during lockdown 5. Obviously, now we've moved to lockdown 3, things are a little bit more rosy. A couple of questions related to that. One, was there any effect from Edgars on the portfolio and maybe any of the other businesses in the sector? And also, now that these businesses have reopened and they're starting to make earnings again, is that driving the rental collections back up to a more palatable level?
So just in terms of Edcon, in the Nedgroup Investments Property Fund, we have substantially less Edcon exposure than the market overall, and that's obviously because Edcon typically occupied space in much larger shopping centres. So they wouldn't go into a shopping centre where the GLA was less than sort of 15 or 10,000 square meters. It's just the type of store and that they wanted was substantially larger than what those shopping centres could accommodate. So we've got a fraction. In fact, if we look at the number of Edcon stores, it's probably only 10% or 5% of what the overall sector has. It's had a major impact on businesses like Resilient, like Hyprop, like Growthpoint, like Redefine, and those companies are obviously still having to deal with it. There's a lot of space that has become vacant as a result of that. We know that some of that space is being filled, but it's been filled at very discounted rates. We've been led to believe that Dis-Chem is looking to take some of the Edcon space in Sandton City at just 85 Rand a square meter, which is obviously substantially below what Dis-Chem would normally pay rent, and certainly would be substantially lower than what Edcon were paying at Sandton City. So, I mean, Edcon is a big problem for the sector overall, but not a big problem for the Nedgroup Investments Property Fund because of that differentiated retail exposure that I referred to. The bulk of the exposure that the Nedgroup Fund has to Edcon is through Jet, and obviously most of those Jet stores have actually traded quite well. I think Jet is a very different business to Edgars. I see yesterday that the owners of Legit have made an offer for Edgars, but are only taking the profitable stores, which obviously means a significant chunk of stores will be sold. And I think Jet is going to be sold separately, simply because the operating metrics of that business are very different. But Edgars is a major issue, but I think it's more than just Edgars. I think some of the other retailers, and this is maybe addressing the second part of your question, some of the other apparel retailers, while they saw a short, sharp burst when they first opened up as people went quickly back into the stores to buy the stuff that they needed, they've seen a substantial slowdown in sales after that. So revenues are nowhere near where they were pre-COVID. It's early days yet. We still haven't had all of the numbers. We should start to see some of the June trading statistics released by either the retailers themselves or by the property companies. But the feeling we get is that we're still probably only sitting at 60 to 70% of pre-COVID turnovers, particularly for your apparel retailers. But even businesses like Pix and Dis-Chem have reported slightly lower turnovers, and that's understandable. A lot more people are getting less income, and obviously are having to cherry pick where they spend that money. I think in the first week of June, everybody spent it on booze. The second week, maybe on clothes, and then there was nothing left. There was nothing left for the rest of the month. And I think that's how it's played out. So if you go and chat to the retailers, that first week was awesome in June, and they all thought everything was back to normal, but it was just people buying stuff that they weren't able to buy in the previous 2 months. And since then, it's eased off a bit again. But as I said in the presentation, it's still too early to tell exactly how the fundamentals have changed, but we know things are going to be different. People are going to work from home. People are going to shop online. Fewer people are going to go to restaurants. Fewer people are going to be entertained in shopping centers. We just don't know the magnitude of each of those things.
Okay, I'm conscious of time, so I'm going to ask you two quick questions, and if you can keep your answers brisk. So one is on corporate action. Yeah, I know it's difficult for you, Ian.
Yeah.
On corporate action or M&A in the sector, are you seeing much as yet?
We haven't seen anything formal, but there is a lot happening in the background. So I would say in any given week, I'm having at least 3 or 4 calls with potential acquirers or potential M&A activity. I've actually got one this afternoon at 2 o'clock. I had one on Monday. So that's part and parcel of what's going on right now. A lot of people see a lot of value that can be unlocked, and they want to try and tap into that. But we haven't had many major announcements other than Grit. Arrowhead and Indluplace are looking at a merger, but that's about it. But there will be a lot to come, in my opinion.
Thank you. And then my last question is overseas exposure within SA REIT businesses. You previously have been pretty scathing about the prices they've been overpaying for properties abroad, but you're seeing a slightly higher level of overseas exposure within some of the companies in your portfolio. Where are we at the moment, and do you see them as more attractive now then?
Yeah, I think importantly, the ones we are investing in, they do it as part and parcel of an expansion into other geographies. So things like Equitis and storage. I mean, that's where we've got most of our recent increases in offshore exposure. So we've sort of sat at around the 12-13% mark. Effective offshore exposure, it's grown to around 17%, and we anticipate that with some of the sort of purchases that we want to undertake over the next 3 to 6 months, that we should get that to somewhere between 20 and 25%, and I think that's a comfortable level. But it will be in businesses where we think that the fundamentals are sound, and we think that the prices that they're paying are the right prices. And again, I would highlight Equitis warehousing in the UK, and storage, a self-storage business in the UK, as 2 of the areas where we will get more exposure to, either through the companies buying more properties in those markets or by us adding to those positions in the portfolio.
Well, on that note, Ian, thank you very much for joining us. Thanks for sharing all your insight into the sector. I found it incredibly interesting. So on that, thanks very much.
Thank you very much, Rob, and thank you to everybody for listening in.
And I'll add my thanks to everyone on the call as well. This session has been recorded and will be available for a replay shortly after today. Please don't forget, later on today, at 4 p.m, we have Anthony Sedgwick from ABAX, the lead portfolio manager on the Nedgroup Investments Rainmaker and Entrepreneur Funds. He'll be talking to us about the second quarter drivers in the local equity market and what we can expect looking ahead. Also tomorrow, we have an update with Ford on the stable fund at 10 a.m. and with Truffle on the balanced fund at 4 p.m. Please try and join those calls as well. Some interesting views from some managers that have been making some correct decisions over the last 6 to 12 months. If you have any feedback on these calls, we'd be very interested to hear from you, as we're incessantly seeking to improve our communication methods with you all. But on that, thank you very much for joining this morning, and have a smashing day ahead. Goodbye.